Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, March 15, 2010. We start the week with some risk aversion in the currency and equity markets around the world, as we had several developments that were negative to risk sentiment. First, we had a Chinese premier aiming sharp words at Washington on Sunday, as he suggested that U.S. efforts to boost its exports by calling for the appreciation of the Chinese yuan were a kind of trade protectionism. He said that it was counterproductive to global growth and that he does not consider the yuan overvalued and that its recent stability contributed to recovery from the global crisis. U.S. Congress members disagree with that and believe that the currency is overvalued, and they're calling for the U.S. Treasury Department to perhaps begin considering some kind of sanctions on China, and that could cause counter-sanctions, which would devolve into a bit of a trade war between China and the U.S. The prospect of that is obviously negative for global growth, and the news sent the greenback as well as the yen higher as a result of traders seeking safe haven. We also had Moody's warning the top credit ratings of the US, the UK, France, and Germany were in danger of being downgraded if the fiscal situations in those countries are not fixed in the medium term. Lastly, we had U.S. equities opening lower and sliding throughout the New York morning trading, which further increased risk aversion in today's market. Let's first take a look at the euro-dollar pair, which we see on Friday rallied past the 1.37 level, which was an important level that we've been watching throughout the last several weeks. But just as fast as we came up on Friday, we have paired those gains for the euro, and we've actually slid below the 1.37 level and the 1.3650 level by noon New York time. The euro was also under pressure ahead of a meeting between EU finance ministers on Tuesdays that could provide more clarity about a bailout package for Greece in case Greece needs it and it finds itself unable to meet its debt obligations. However, the lack of clarity and some conflicting comments from different EU officials has been pressuring the euro. If we plot a FIBO retracement levels from our low near 1.3550 to our high near 138, we see that we had a support at 38.2%, which corresponded to 1.37, but we've cracked that level and we've moved below the 50% retracement of this upswing, and we're now testing the 61.8% area. So we'll see what happens with this level, and if we manage to bounce off, then perhaps this is just a correction to the rally we had seen in the latter half of last week. But if we break below this, then we could see the 1.36 level and perhaps even the 1.3550 level tested. The warning from Moody's affected the pound rather strongly, as it paired its gains from Friday's session in about a 3-hour span in European trading. We fell from 1.52, which was our high for the session, down to 1.5020, our low. The theme of the fiscal deficits hurting the pound has been evident throughout the past several months, especially as the polls in the upcoming election have tightened and there are prospects of a hung parliament in the UK. That would make it more difficult for politicians to come together to cut spending and increase taxes in order to shorten the gap in its budget shortfall. Now, this 1.52 level was a very important level of resistance, as we had cracked it back here in late February, and we tested it once on March 8th, and now we tested it again to end last week, but we were unable to move above it. So if we connect our lows from the end of February as well as here on March 10th, we're in a bit of an ascending triangle pattern, so we're still consolidating following our very sharp swing down in this pair throughout this year. Now, the yen was also a strong gainer in today's session. Here we're looking at the euro-yen over the past 3 months, and we see this very important 125 level. It had acted as support in late January, then we broke below it, and then it became resistance here in late February. Now we did see this rally throughout March as the worries about a Greek default have eased, and that helped to boost the euro. But after we test this 125 level, we are retracing some of our rally from last week in the pair, and we'll see if this continues, as we did break below this other important shorter term resistance level around the 123.90 area. Similar to the euro dollar, we can plot Fibonacci retracement levels, and we see that right now we are testing the 50% area, the 50% retracement area as our support. So if this is just a correction to our rallies in last week on some risk aversion to start the week, will be made more clear as this trading week goes on. Now let's switch gears a little bit and take a look at some of our commodity linked and growth linked currencies like the Canadian dollar. Here we're looking at the US dollar Canadian dollar pair, and in Friday's trading we moved sharply lower below this important support around 1.0220, and we hit a new low just at 1.0150. However, with the risk appetite waning in today's session, we saw the greenback rally and pair these initial losses. Now we have been trending down in this pair, though it has been a kind of a slow, gradual move down. So we are likely now to test our old support, which is around the 1.0250 level, 1.0240, perhaps now as resistance. If we bounce down off that resistance, then we could say that we are continuing this downtrend in the pair we have seen after we had rallied in January. So oil prices had reached 80, plus we had very positive data coming out of Canada, so that has been supporting the Canadian dollar, and this actually moved to 1.0150, had knocked out our lows for this pair from 2009. So there might be a little bit of consolidation, but we'll see if we move back towards testing parity in this week or in the next week. Taking a look at the Australian dollar US dollar pair, we see that we had tested some resistance at just below the 0.92 level, and in today's trading, just as we've had risk aversion, we've seen the pair move in favor of the greenback. So we did move below our support from late last week, our short-term support here, though we haven't dropped much lower than that, but we are retracing a bit more of this rally that we have seen in the pair. So starting in February 25th, we had moved about 380 pips higher, and if we plot a Fibonacci retracement of this whole swing, we could see that we're testing the 23.6% level, which is our first support level in a Fibonacci retracement. So will we move down to 0.9050? That'll depend on how equities behave in the following session, as well as throughout the rest of the week. I just want to take a look at one more pair before I look at some fundamental news, and that is the Euro-Swiss franc pair. And if you take a look at this, we see a very sharp fall in today's trading, which follows the sharp fall in Friday's trading. So we had seen a very tight ranges in this pair up until these last two sessions, and it followed the Swiss National Bank upgrading its forecasts on inflation and growth, which supported the Swiss franc, but it also held the same language that it did not want to see a rapid appreciation of the Swiss franc against the euro. So it seems that traders are testing the SNB and seeing where the line in the sand is for this pair, and we had seen back in February 4th a sharp intervention when we reached the 1.4550 level, but we broke through that today, and now we've tested the 1.45 level. There hasn't been a sharp move up in this pair, which would have suggested that the SNB has intervened, so we'll see where the SNB feels the line in the sand is for this pair. In fundamental data from the US, we saw industrial production rise 0.1%, which matched expectations, and it's the 8th straight month that we've had a positive output in the US. A second report, the Empire Manufacturing Index, while declining from its levels in February, did beat expectations, with the index registering a 22.9, which is far above the 0 level separating contraction and expansion in this index. Similar to the industrial production data, we see that the last 8 months have been rather positive for this index, which is a good sign for US manufacturing. Now let's take a look at the fundamental docket for the upcoming session. Tonight, Australia posts its RBA meeting minutes, while overnight the main release will be Germany's ZEW economic sentiment. Tomorrow, the U.S. posts data on housing starts and building permits, as well as import prices, but the main draw will be the FOMC interest rate decision and statement at 2:15 p.m. And that will do it for today's recap. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.